Hello, everybody. I'm your host, Eric Bird, here at StopStrugglingNow.com. And today we're going to talk about the 1% down payment for a mortgage loan. That's right, it's dangerous, ladies and gentlemen. Don't fall for these tricks. But once again, I got to go over it because some people can qualify because all you're going to need is a 620 credit score. Let's get into it. And welcome. Stop struggling now gear. Check. And please like, subscribe, and click the bell below so you get the latest updates. Now, let's get to it. All right, welcome back, ladies and gentlemen. And once again, please share the videos. Why? Because we have hundreds of videos that can help people. This information I'm about to give you, yes, it's 1% down payment. It's by Rocket Mortgage. And you see we're on the Stop Struggling Now YouTube channel page. You see members of the channel. So please, if you want to become a member of the channel, you do have special perks. So click the join button over here on the right hand side. Without further ado, I'm going to get into this. Leading lenders roll out 1% down payment mortgages. This is Rocket Mortgage, ladies and gentlemen. 1% down payment. Let's put things in perspective because a $250,000 home is going to be $2,500 down payment. How Rocket Mortgage works is they will cover the other 2% for your full 3% down payment. We'll get into that shortly, but I want you to see here, Rocket Mortgage, the largest lender in the U.S., announced a 1+ program this week. Now, do you think Rocket Mortgage is going to be the only one? Hell no, ladies and gentlemen. They need that paper to turn into derivatives. United Wholesale Mortgage also has a 1% down payment loan, but it's a little bit different. Now, it piggybacks off the Fannie Mae's Home Ready Mortgages and Freddie Mac's Home Possible loans. But again, this turns it into a conventional loan. I'm scrolling down just so you can see the example here. I will have a link down below in the description so you can come to this page and see it for yourself. Rocket offers this scenario as an illustration. Just what I mentioned. A buyer of a $250,000 home with a home ready or home possible mortgage needs at least 3% down or $7,500. But under this new program with the 1% down, Rocket covers $5,000 or 2% of that down payment through a grant. The borrower then needs to put down just $2,500 or 1%. Right about now, a lot of people are going, okay, what's the credit score? Get this. 620 and up can qualify. You heard me correctly. 620 and up can qualify for this. That's the first thing. Let's get to the second part, because if you do not put down 20% for a mortgage, then you normally have to have PMI, otherwise known as private mortgage insurance that you see here. And in this program, Rocket will be paying the PMI, no cost to the borrower. And just so you know, as they mention here, on a $242,500 loan, remember it was $250,000, the 3% is $7,500. So that's where we get to the $242,500 loan. And that PMI would have cost somewhere around $245 a month. It's being paid for you, so no PMI. So that means you are $245 less than other people who have the exact same 3% loan. It's just giving you an idea. Now, I want to give you the bad. This is setting up people improperly, in my opinion. The reason why, it costs you 3% generally. Whenever you're renting, it costs you 3 months rent. First, last security, or first security deposit, whatever they call it, you generally have to put 3 times whatever the monthly rate is down. So for rent, it costs you $7,500. Here, they're giving you a mortgage that could be 250, 300,000, 400,000, 500,000, and all you have to do is put 1% down. A $400,000 home, 1% is $4,000. And then they're going to cover the other 8,000. That's crazy. And also your debt to income ratio, they're going to probably allow you to be not only 30%, but they're going to be pushing 40%. Understand, 40% of your income going to your home. That does not even take into consideration taxes, which, depending on what state you're in, this could be an additional 5,000 a year, 6,000 a year. So that means an extra $500 or $600 on top of your mortgage note. This also doesn't include any HOAs. This doesn't include if you have repairs to do. This doesn't include insurance. And depending on what state you live in, insurance could be skyrocketing, and also insurance will go up. So just because your debt to income ratio for the loan could be 40%, let's say, now all of a sudden you're going to owe an extra 500 to 1,000 on top of that for your property taxes and your insurance of your home straight away. Now what? You're going to be well over 50% of your income going to where you live is not a good combination, ladies and gentlemen. Do not attempt to sign up for this if that is the situation. If they're allowing you 40%, you should sign up for this if it's like 25%, something like that, because there's something that you're not going to deal with very well. If insurance or your property taxes go up the following year, sure, you'll have a fixed note, but now you're going to be paying an extra 5 to 10% of your income. So you don't want 50% of your income going to this. All right? That's what I'm saying. This is 2007, 2006 all over again. It's benefiting the mortgage companies. Here's United Wholesale Mortgage. All right? I'm going to go through this a little quicker because the link is down below where you can actually go here and read this for yourself. The lender pays 2% of the purchase price up to $4,000 with United. All right. That means the down payment benefit maxes out at $200,000. A borrower who takes a $400,000 loan under the program would get 1% of the down payment from United Wholesale Mortgage and need to come up with 2%. But nonetheless, that's $8,000. Okay. Again, this is getting people who probably shouldn't be buying a home into a home. What could go wrong? Well, here goes some other things. Income limits. In some of these states and cities, you can only make 80% of the median price. Okay, just so you understand. 80%. So let's say the median price is 90. It must be around 90,000. 8 times 7, so maybe 100,000. Yeah, it's got to be close to 100. 97,000 must be the median price in Atlanta, because now you can't make no more than 76,560. That's about 80%. So now you're making less than the neighborhood average, but you're going to go buy a home with 1% down and have a high mortgage. And then on top of that, you never know what's going to happen with insurance and property taxes, which are going to rise for sure. And you don't know when a washing machine goes out, or a dishwasher goes out, or a refrigerator goes out. I mean, these are the things that drive me crazy. They're setting up people who actually make less money for possibilities. And also what this will exasperate, a person that only puts down $2,000, $3,000, $4,000, and if their house drops in value by $50,000 to $100,000, they'll just walk away. We've seen this play out before, ladies and gentlemen. Is there a catch? These programs are sweet deal for borrowers, so much so that there's no guarantee the terms will stay the same, as evidenced by United Mortgage's decision to boost income limits. So what they mean is they boosted the income limits depending on the city so you can qualify. That's what they mean by that. And then more lenders are even getting creative. Ladies and gentlemen, this is outrageous what's happening. Movement Mortgage. Look at this. They're setting people up. Movement Mortgage this month announced it's now allowing FHA borrowers to take out a 10-year second mortgage to finance the 3.5% down payment required for FHA loans. This means you got zero down if they allow you to do this. But you automatically have a second on your house for the 3.5% down payment. And again, they're going after people that have a 620 and higher credit score, meaning 640, 620, 660, 680. Not people that have 760, 750s. Of course, those people can qualify for this. But now that's a no money down scenario if I can take out a second. If I can buy a $400,000 house, 12, well, more than 12, it's going to be like 18,000, I believe will be the number. But somewhere around there, you're telling me now I can take out a 10-year second on this, which over 10 years, that's going to be small. But if the interest rate's like 7.6% or 8%, that little bit of money is going to cost you a hell of a lot more than $18,000 over 10 years. All right, just saying. That offers just one-way lenders responding to the 1-2 punch of affordability squeeze and a sharp slowdown in mortgage applications since 2021. There's the whole deal here, ladies and gentlemen. That one sentence, the slowdown on mortgage applications, a 10-year low and all that, on other factors with the housing markets, mortgage applications, 10-year low. This is why they're doing this. This is not for you. Do not fall for this unless you have the income to handle an extra $1,000, $1,500 a month on top of your mortgage. All right? Do not do that. This will be very bad. You will end up losing your home. That's all I'm going to say about this, because you're going to be over leveraged if they allow you to get up to 42%, because they've allowed people to get up to 42%. All right? So I just wanted to bring that up. I'm not going to talk about anything else, but I do want to go over here to this Movement Mortgage. Look at this, the details. Movement Boost is what it's called. And it could cover your entire FHA down payment plus 1.5% to put toward closing costs via repayable second lien on a 10-year amortization term and a rate at 2% above the first lien rate. So if you have an 8% loan, you will have a 10% loan for this second. You got that? See, that wasn't in the other print, was it? Available for first time and repeat home buyers. All of these that we mentioned, the Rocket Mortgage, the United Mortgage, and Movement Mortgage. It's for first time and repeat home buyers. Available nationwide is the Movement Mortgage, with the exception of New York. All right. And here's the other kicker. You can have gift funds, meaning normally they say you have to have the funds. Where did they come from? Did you earn these? Nobody can just give you the money. They can't give you the down payment. Well, on this Movement one, you can have gift funds if you're going to be involved with the FHA for a larger down payment or to cover additional closing costs. That's interesting. Minimum 620 credit score. And this right here is outrageous. Maximum 50% DTI. This is outrageous. So if you have a first and they give you 40%, 42%, and now you get this second, you could be at 50% DTI, and they will give you a second on the house to make sure it's 50%. Now you're going to be over 50% of your income because you still have taxes to pay. You're still going to have insurance to pay. You're still going to have HOAs to pay in a lot of situations, and whatever else fees and that are involved in the city or county or state that you live in. It has to be a primary residence. Single family homes, multi-family homes up to 2 units, so you can have a duplex, and they will do condos. All right, ladies and gentlemen, well, here we are. What can I tell you? It's back. The worst of the worst, they're back. And this is a recipe for trying to keep the mortgage market afloat, home buying afloat. But this is going to be a situation down the line when costs increase a year over year, 2 years from now, and now these debt to income ratios, because of these programs, are going to be something like 55, 60% of the income. And now people are going to not be able to pay. That's just the way this is going to be. Now, I'm just giving you the negatives because this could help some people out. This is true. But don't fall for this. You have to be a responsible human and adult in this situation. You have to make sure that if things go up an extra $2,000, $1,500, are you going to be able to afford it? You and your household. Because if the answer is no, do not delve into this arena. I'm just saying, because if you do this now and home prices continue to just stagnate where they are right now and nothing happens, because the Federal Reserve is going to reduce interest rates, I believe, later this year, probably in the month of December or something like that, then home prices will start going up, which will be a good thing. But that also means potentially your insurance payments or property taxes could go up as well. So all I'm saying is make sure that your debt to income ratio is not near these limits of 50% if you go with this movement mortgage situation with the second loan, and make sure you're nowhere near 40% DTI, debt to income ratio, okay? Let me know if you're interested down below in the description box. Let me know what you think about this 1% loans. Let me know if you think this is very hazardous, or do you think this is an opportunity? The government is touting this, and these lenders are touting it as an opportunity for people that are less fortunate and make less income. But that's not the people that should be buying a home. There's upkeep involved. There's roofs. There's maintenance involved in a home. This isn't a toy box made of plastic. It's going to require maintenance. So just keep that in mind, please, ladies and gentlemen. But I did have to mention this, and I want to forewarn you. But this also means those of us who are savvy investors, we can sit back and relax, because some of these homes, you know what's going to happen. They will be in foreclosure. This will cause an additional housing crisis situation. It just depends on how many people do this. And with all that said, thank you for watching. Thank you for listening. And please like, subscribe, and click the bell below so you get the latest updates. And I know it's hard out here, and that's why they're making it harder for you. They're trying to get anybody and everybody with a loan, because for them, they can sell the paper. Remember, a $400,000 house, they have 100 of them. That's a lot of money, ladies and gentlemen. 40 million. They can go sell the paper and get paid 10 million, 5 million, 15 million up front. They don't have to let the paper mature. So for them, it's a win-win, because they will sell the mortgage. Why take the risk? All they had to do was make sure you had the paper and somebody signed on the dotted lines. Let somebody else have this bad paper that's going to probably be a situation of 20 to 30 or 40% defaults. Take the money up front and run. That is the game plan here. And with all that said, keep your head up, keep moving, and I'm out.